Good morning and welcome to the last edition of Green Up TV. I'm Thomas Girard, the Global Head of Natixis CIB Green and Sustainable Syndicate. Today we will revisit the topic of transition planning, following our initial discussion in June, where we outlined Natixis CIB approach and focus on the automotive sector through an expert panel with Ojo BHF. In this session, we will delve into market perception by hearing from investors to understand their views on transition planning, their expectations from the companies they invest in, the significance of climate transition plans in their investment strategies, their priorities when evaluating the governance of transition plans, and last, the challenges they encounter in assessing these plans and their impact on investment decisions. But first, let's kick off with some important news of this month. Let's begin with something that you may have already picked up on. The NZBA has officially ceased its operations due to increasing pressure. This decision comes after several major banks withdrew from the US, Canada, and Japan, including 3 European banks this past summer. While this news is unfortunate, it was not entirely unexpected. Earlier this year, the NZBA started reviewing its guidelines and member obligations to align with the Paris Agreement goals. In July, the steering committee sought input from members to create a new framework by September 25. Ultimately, on October 9, the committee announced the result of the vote, marking the end of the alliance in its current form. It is important to recognize the achievements of the NZBA since its creation in 2021. At its peak, it included nearly 140 member banks, representing about 40% of the international banking system. Over 100 of these banks set decarbonization targets based on the framework developed within the alliance, which calculated CO2 equivalent emissions linked to their loans. So far, most of the banks have not questioned their targets. The NZBA is evolving. It will change its name and operational model while continuing to promote best practices to help banks develop and implement decarbonization strategies for their portfolios. Although the NZBA has officially ended its current form, the guides it created will still be available and discussions are underway to see how to keep advancing these efforts. A new working framework is expected to be established within the next 3 to 6 months. Next, let's focus on the realm of technology. In our increasingly digital world, a new report from the Chief Project highlights alarming trends in energy consumption, specifically related to artificial intelligence and data centers. The prominent French think tank dedicated to energy transition has been examining the relationship between digital technology and energy use for several years. In its initial report on digital sobriety, published in 2018, the Chief Project identified a significant rise in energy consumption tied to the digital sector, a trend that has continued to escalate. According to its latest findings, electrical consumption from data centers is projected to reach 420 terawatts in 2024, nearly equivalent to France's total annual electricity consumption of approximately 450 terawatts. This represents an annual increase of about 13% over the past 5 years and could potentially triple by 2030. Obviously, the environmental implications of this surge are concerning. In the US, for example, the Secretary of Energy has indicated a reliance on fossil fuels to meet increasing energy demands, including plans to extend the operation of aging coal-fired power plants. In this context, we are also anticipating the development of new gas power plant capacities. The Chief Projects warn that unchecked energy consumption tied to AI could have severe consequences for climate change efforts. The report call for immediate action from policymakers and industry leaders, advocating for strict limits on energy consumption and the development of energy-efficient AI technologies. As we navigate the intersection of technology and ecological responsibility, the report stresses the necessity of prioritizing innovation that aligns with climate goals. A new framework promoting sustainable practices is expected to be established within the next 3 to 6 months, guiding the industry toward a greener future. To conclude on a positive note, here is some encouraging news from the renewable energy sector. The International Energy Agency has released a new report forecasting a significant increase in renewable energy capacity in the coming years. By 2025, at least, 750 gigawatts of new renewable capacity are expected to be installed, marking an impressive growth of over 20% from last year. China will play a major role in this expansion, projected to contribute nearly 60% of the new capacity. Solar energy remains the most widely used technology, solidifying its position as a key player in the renewable sector. Looking ahead to 2030, the report predicts that electricity from renewable sources will become the leading form of energy generation. These changes come despite challenges in the US where renewable initiatives face resistance. In Europe, forecasts have improved slightly, thanks to increased investment in offshore wind power, especially in Germany and Spain. However, the report also identifies obstacles. In France, for example, the electricity grid faces risk of overcapacity and declining profitability for renewable sources. Additionally, the agency report highlights the heating and transport sectors. Transportation is currently the largest share of end-use energy consumption, with a projected 50% increase in energy use by 2030. Notably, 45% of this growth is expected to come from new renewable capacities. Overall, the International Energy Agency findings emphasize the importance of continued investment and planning to support a sustainable energy future. Finally, here is our figure of the month. $132 billion is the total volume of green loans emission to date in 2025 as per Dealogic market data. It marks a record high that highlights the market's demand for use of proceeds instruments and the significance of green financing for data centers, renewable energy projects, and energy infrastructure. But let's now return to the main topic of today's edition. To discuss investors' approach on transition planning, I'm pleased to welcome Béatrice Verger, ESG investment specialist within our Green and Sustainable Hub at Natixis. Good morning, Béatrice.
Good morning, Thomas. I'm very happy to be here.
Good. Likewise. So at Natixis, we regularly conduct surveys with ESG specialists to ensure that we comprehend market dynamics and structure meaningful sustainable finance framework and product for our borrower and issuer clients that align with our investor client needs and expectations. All the results of our surveys are available on our website. In this context, we conducted an investor survey from April to September, comprising around 25 questions aimed at understanding ESG specialist perspective on corporate transition plans. Béatrice, you were leading this project. To start, maybe can you provide more specific details about what was the objective of the survey and who participated in it?
Yes, indeed, this survey is part of a broader research initiative on the evaluation of company transition potential through the design and the execution, implementation of a transition plan. So the aim is to gather insight on the key elements that investors are looking for and how do they use this element when they looked at company transition plan. Our aim was also to understand the challenges that investors are facing in this assessment of transition plan. In total, our respondent sample was made about 30 investors, being from asset managers firm and insurance company located in Europe. And their institution together represent more than 8.5 trillion euro of asset under management, split between large generalist asset manager and also more specialized boutique.
Okay, thank you. So we can say that we are satisfied with the number of respondents and their typologies.
Yes,
I would say.
totally.
Okay, thank you. Would you be able also to provide us with some notable figures that caught your attention on this survey?
Yes. Well, first, most investors consider themselves to be well informed about the topic, as 80% report to be very familiar with the concept of transition plan. Investors are focusing more on the level of ambition and the alignment with climate scenario, rather than getting into a lot of details on how to do it when it comes to implementation levels, efforts to be done, and also governance process. Second figure that we can see on the slide, in-house methodology are quite widespread, and I must say at a level above our first forecast, with 65% of respondents relying on in-house framework.
Okay.
For investors that use existing framework guidance in the market, the most widely used and publicly available is the TCFDs, one of the first to establish element on transition plan, following by the Carbon Disclosure Project, the CDP. Another key takeaway linked to this figure is the fact that third-party assessment does not gather much support from investors, as 75% of respondents indicate using it only or not at all. So some reluctance about relying slowly on third-party assessment. But for investors that nonetheless rely on third-party assessment, preference is given to open data and methodology, and non-profit initiative with strong visibility in the market, namely SBTI and TPI.
All right.
And last figure, 60% of the investors in our sample already manage transition-focused product, especially through listed equity strategy with a best-in-class approach, meaning that their strategy they will invest in companies that present the best transition plan.
Okay, that's interesting. But what do investors expect from the transition plans of companies they're investing, generally speaking?
Well, all our respondents expect their investee to develop a transition plan.
Okay.
And more than 1/3 state that when this transition plan does not exist, they request them to the company. Yet, it is important to note that no investor refuses to invest in a company only due to the absence of a transition plan. Then, clearly, the need for investors to request a transition plan will depend on the company sector. Power, obviously, steel, building, real estate, and land transport are the sectors for which the transition plan seems to be the most requested. In addition, and maybe this point was quite unexpected, the fact that the company is a listed company or a private company is also an important topic, and even a more important topic than the geography, localization of the company or the size of the company. So it can be explained maybe by the fact that the minimum requirement related to listing company is quite available in the market, especially through the sustainable finance regulation.
Okay, thank you, Béatrice. I've seen displayed on slide different use cases, and I wonder what motivates investors at the end of the day to examine transition plans of investees.
Investors expect the transition plan because it serves as a tool for effectively different use cases. engagement is the most mentioned one. 85% of the respondents use this transition plan of company as a tool to engage, to discuss with the company.
Sense.
Then it is followed by the fact that they use it as a tool for their portfolio alignment. A lot of asset managers have net zero commitment, and they use it also as risk management and thematic investing. Again, as we already mentioned, no respondent refused to invest or to engage with a company only due to the absence of a transition plan. Yet, it may influence the global ESG evaluation of a company and at some point in time the investment decision, in particular when it is for products that fall under the SFDR classification, Article 8 or Article 9, and also for the products that may have some ESG European label, especially the SRI label, that have put some guidelines on transition plan. So this diversity of use case comfort us at Natixis on the importance and the extensive consequences on transition planning and the fact that we support our client in their climate transition.
Okay, so we are, I would say, at the beginning of a journey, but there is already foundations. And what I'm interested in is maybe to touch upon the evaluation of transition plans. You previously mentioned that several of our respondents have created their own analytical framework. That's stunning, and I would be glad if you can further elaborate and maybe tell us what factors do investors deem most significant, for instance, but also what essential components should these transition plans include to be seen as credible by the market?
Yes, yes. Well, when investors evaluate corporate transition plan, climate is the primary focus. Yet they are also considering other key elements, such as the just transition, nature and biodiversity aspect, as well as adaptation and resilience, but really the focus is climate. And when they review a firm plan, investors looked for several key elements. The most important of the one is the metrics related to greenhouse gas emission and the plan target perimeter. Then it is followed by the strategy time horizon of the company and the mechanism in place to track the progress and ensure the accountability of the plan. Then, when the investor assesses the transition level, they pay particular attention to the core decarbonization measure and the plan for exiting or phase out carbon intensity activities and assets. We mentioned already that maybe governance criteria are often less critical, but investors still want to know if there is a proper framework for climate change, how climate change is integrated in the risk management process, and if a kind of incentive exists are in place in the company linked to the achievement of the climate goals. So overall, I would say that investors are looking for strong visibility, time-bound objective, more than very detailed explanation on how to achieve this goal. But maybe one exception is the financial resources allocated to the transition. It is a very important criteria for investors, as I mentioned it, in 75% of the case. Okay, well, that's very interesting again. I've got a final question for you. Can you also tell us what are the challenges do investors encounter when assessing transition plans? Is it something that was clearly mentioned by investors or not? Yes, definitely. The result of our survey indicates that for investors it is difficult to assess long-term viability and feasibility of the target. As well as assessing precisely the decarbonization levels and as well as the investment related to these decarbonization levels. And finally, and I am not going to surprise you, Thomas, the lack of standardized metrics, data availability is also an important obstacle for investors to assess very concretely and correctly the company transition plan.
Okay, well, thank you very much. It seems to be a very comprehensive survey that you've been conducting. Congrats.
Thank you.
Again, all the results of the survey will be available on our website. And let's hope that it could be seen as a compass for our clients to navigate their transition journey. Thank you, Béatrice. And let's move
Thomas.
to the second roundtable of the day. On this second roundtable, I'm glad to welcome on stage Charles Goodstien-Olvier. Good morning, Charles.
Good morning, Thomas.
How are you today?
Very good, thank you. Glad to be here.
Yeah, likewise. Thank you for accepting the invitation. I know that you're coming from London.
Indeed.
So thank you for making the journey. Charles, you're Sustainability Officer at Natixis Investment Manager.
That's right.
Okay. As I said, we are glad to have you on stage because we would like you to elaborate on what transition planning signifies for a diverse group of asset management companies like Natixis Investment Managers that obviously operates across various geographies, invest in a wide range of asset classes from listed to alternative investment, and also engage across different market segments.
Of course. So Natixis Investment Managers covers 18 autonomous affiliates, covering all major asset classes from listed equity to bonds to private equity to alternatives such as real estate and infrastructure. Of course, that means that the way that we approach transition and transition planning varies enormously. Currently today, in terms of transition products, what we see is more of a move towards low carbon or climate solutions products, such as products at Mirova, DNCA and thematics. These will be looking at best in class for carbon intensity and other such metrics. But actually what we're seeing in the market today and what we're moving towards and exploring internally is a move away from low carbon to infrastructure that is moving and changing its performance on climate and carbon expectations to broaden environmental and social outcomes in investments. So low emissions infrastructure is incredibly important, but at the same time what we're looking at is that only represents a fraction of the total decarbonisation required. So energy infrastructure such as renewable energy and EV. But actually the most important thing from a global change, for a global economical shift, is ensuring that progress comes from all sectors decarbonising. So what we're thinking about is how we can make and how we can evaluate companies who are currently dirtying and making them more clean, and examining which instruments can be best utilised to build funds to invest in these sectors.
Okay, that's clear. Thank you, Charles. I would suggest before we dive deeper into Natixis Investment Managers' approach to transition planning, to maybe ask you for a few comments, if you have any, on the survey presented by Béatrice. What would you like to share with us? Any reactions?
I think my first reaction would be the figure 65% of investors using a proprietary methodology for evaluating transition plans.
Okay.
It's certainly something that we see amongst our affiliates in particular, but actually at NEAM we're exploring the use of the Net Zero Investment Framework, NZIF, that's pioneered by the IOGCC, as a framework for examining transition plans, core elements including their emissions performance, their governance, their disclosure robustability, their ambition and their wider decarbonisation trajectory. We see this as being used by more than 50% of asset owners and asset managers as a sort of cornerstone of transition plan analysis. However, at the same time, what we're seeing outside of the market amongst market data providers is increasingly more and more innovative metrics related to transition, such as transition value at risk and transition pressures that companies can be facing to analyse how well they'll withstand certain scenarios and certain temperature pathways.
Okay, that's interesting. Béatrice, is it a point that emerged from the survey?
Yes, just to rebound on Charles' remark, effectively the net zero investment framework has been mentioned by a certain number of respondents and spontaneously, because it's not, as a CIB, an initiative that we really rely on, definitely, but it was spontaneously mentioned by around 20% of our respondents. So not the 50% of the market, but indeed it is a framework very well known by investors.
Okay, so a market standard that need to be taken into consideration, I will say. Is there any other comments you'd like to share on the survey?
I think what was quite surprising was to see that amongst the investors sampled, 60% already had transition products and services within their offering. We saw this as quite high. As I said, at NEAM currently we do have transition or products under a transition label which are more focused on climate solutions, so investments in infrastructure through Mirova and Thematics, which are more thematic investments in climate and water. But actually what we're beginning to see, or what we'd hope to see, is a new change of that definition of transition, moving away from low carbon, as I mentioned, towards how we invest in really brown to green strategies. And that's actually something that has motivated an internal project of ours to understand how we can invest in transition further.
Okay, that's interesting. And can you tell us maybe what product approach you have regarding transition at NEAM, and how you've been maybe factoring the regulation aspect or the regulatory aspect, be it hard and soft law? Can you tell us about that?
Absolutely. It's something that certainly has been a main driver of us exploring this internally. As you may know, the Sustainable Finance Disclosure Regulation in Europe is now undergoing a second revision, which we believe that to be included in it a category on transition. So this is ensuring that we need to think about exactly what that will look like for our affiliates who may need to redisclose or recategorize products which are currently under the Article 8 and Article 9 regime. So that's been a major directive, but at the same time, product labeling that currently exists in the market, so the SRA label that Béatrice mentioned previously, has now a new version which is ensuring affiliates are looking at how to credibly and analyze a credible transition plan within their investee companies and their portfolios. So there are definitely a number of factors on the regulation side influencing our analysis of how to do transition at NEAM. At the same time, though, from a peer approach, what we're beginning to see is an increasing number of funds labelled as transition with quite an erratic standard, some of which are on the Article 8 side and have basic ESG integration, some on the more thematic side that are investing exclusively in renewable energy and low carbon infrastructure. But actually the standards are quite mixed, and it's important for us to understand how we can have a cohesive, more uniformed definition of transition for Natixis affiliates.
Okay, thank you. Maybe turning to you, Béatrice, in your monitoring of market dynamics from an investor perspective, with regard to ESG and green and transition approach, do you share the same view with Charles? Can you provide maybe us with a few figures?
Yes, I totally agree with Charles' vision, because when we look at the Morningstar database, we can identify globally over 170 funds worldwide, but mostly are European funds, that use the terminology transition in their name. And often the market innovation starts with listed equities, and it is the case here, as more than 60% of these funds are listed equity funds, followed by around 20% fixed income product. And in addition, as you mentioned, Charles, a lot of them has also climate in the name. So they are climate transition funds, so to make reference with what you say. And in addition, to complement, 80% are Article 8 for those who fall under the SFDR classification. And we know that Article 8 can encompass very different strategy. So we see that the number of funds with the terminology transition is growing following market expectation, long-term investment, but also due to the regulations, the upcoming SFDR classification and the new ESMA guidelines that identify clearly a transition category, and also the label. So it's very important, as you mentioned, Charles, to what is behind transition. It can be everything, nothing. So we have to define that and to work on that.
Yeah, no, it's true. And what I wonder is how do you bring coherence and maybe a certain level of harmonization at group level with regard to your affiliates, and how do you to push I would say a similar consideration of transition and approach to the topic for your different diverse and complementary affiliates?
Of course, Natixis is by nature diverse by design, so it's very hard to bring a full coherence or consistency amongst affiliates. But at the same time, the way we view transition investing is really through three avenues. So investing at a product or service level, which may complement a fixed income approach, investing in an entity who may have a credible transition plan, and which we've already discussed on the listed equity side, and also following potentially from more a passive approach, exploring or investing in committing to portfolio level targets and benchmarks that a fund would follow. So that's really three ways that we're thinking about transition investing. But at the same time, and thinking about transition plans themselves, in terms of the metrics that we're expecting for a good transition plan to display, certainly moving away from current projections to more future indications of what that transition would look like. So things like capital expenditure towards technology, for example, towards research and development, and also ensuring that having robust targets that are not revised, and ensuring that those targets and those ambitions stay dynamic and change as the company evolves in its life cycle.
Okay, clear, ambitious. And pragmatic. So let's go back maybe to the evaluation of the credibility of transition plans.
Yes.
What do you suggest to your affiliates?
It's a very challenging thing, and indeed, and we recognise that, and much of the points that Béatrice made earlier, transition changes from sector to sector. So understanding that not having a best-in-class approach, comparing lots of different issuers from different sectors doesn't work, but ensuring that you have a scenario alignment for sector by sector and understanding their decarbonisation trajectory can certainly help analyse and understand who's a best player. At the same time, looking at CapEx, as I previously mentioned, and actually looking at who is investing most in research and development and in technology can certainly ensure that you can identify who is diversifying their business such that they are ready for different temperature and different transition scenarios in the future. And again, leveraging NZIF and leveraging NZIF such data solutions that are in the market. So,
okay, thank you, Charles. What else? Yeah, we noted in our survey that transition plans are used as an engagement tool in the overall ESG assessment. This is what you said of companies in 85% of cases, which is a huge number. What's the situation at NIM? And I would say beyond traditional or historical shareholder engagement practices, from a stewardship perspective, broadly speaking, how do you deploy your strategy by engaging with your investees?
Certainly. So I think that, as you say, transition plans are a cornerstone of engagement and stewardship, and it enables our affiliates to understand exactly the companies they're investing in, and their future plans. However, at the same time, we recognise that sustainable finance regulations such as the CSRD will limit necessarily the amount of companies who are able to disclose those transition plans. So obviously using their positions on issuers to motivate for the development of transition plans certainly is a key part of their engagement process. However, at the same time, and I noticed from Béatrice's survey that 20% would use filtering criteria to sort of exclude potentially companies who did not have a transition plan. Again, it's not something that we necessarily support. We believe a qualitative and a quantitative approach is best employed, and actually ensuring that you're motivating a company to adopt a transition plan and to adopt robust targets and strategy for the future would be a best approach before excluding any company from a transition fund in particular. And in terms of risk management, I know that you mentioned that you use as a risk management tool. Of course, climate stress testing is a core component of transition plans in particular. It's been recommended by the TCFD, but also the ISSB as a sort of a major standard. And it can certainly help, particularly examining a company's exposures to different temperature scenarios and how it adapts to those scenarios. It can certainly be a very valuable tool, particularly on the real asset side, for understanding how well exposed an infrastructure or real estate may be to climate stresses, and what appetite an investor may want to take in terms of transition risk. So
okay, now that's clear. Engagement for the future and bring, I would say, climate and transition as part of the strategic dialogue we can have with partners, with clients, and we are our investees or the companies or the project we are financing. This is key. Okay, thank you both for your presentations and the quality of our exchanges. We hope that we provided interesting insight on the topic of transition and that we properly gave voice to investors on the topic. See you in November for the next edition of our Green Up TV. Béatrice, Charles, have a good day.
Thank you, Thomas.
Thank you.